Good morning, and here we are looking at mortgages and foreclosures after the recession. Um, this is going to be a good chapter because I think it's something you can use even though, again, you're not going into business right away. Everybody needs to understand mortgages and even more so foreclosures. We've got some terminology that may seem a little bit odd, so let me run through that very quickly. There's something called an ARM, which is an adjustable rate mortgage. This simply means that when you get a mortgage, maybe you'll start off with a 4% interest rate. And if a certain index goes up, if the rate of inflation goes up, then that mortgage rate may go up. Or if the prime rate interest rate goes up, then the mortgage rate could adjust up or down. Usually they have ceilings on them now, so they can't go up too far. A fixed rate mortgage is once they say the rate is 4.5%, that's what it is. It can't change. There's an APR, which is the annual percentage rate, which is the real interest rate when you look at fees or any other charges that may come up throughout the year, adjusted to your interest rate. A balloon mortgage, interesting, you may get a loan for, 3.5%, and it's in 5 years' time, the entire loan is due, so you have to go out and get another mortgage to cover that, or another loan. Deed in lieu of foreclosure simply means that you are having trouble paying for the mortgage payment. Maybe you're very close to the end of it, and the bank looks at it and says, we're just going to convey this deed to you in lieu of, or instead of foreclosing on you. Forbearance simply means that you've worked out another arrangement for the mortgage payment, which is either lower or maybe extended so that you can afford to not go into foreclosure. You have negative amortization, which is an interesting term. It basically is talking about amortization, which is how interest, is allotted or spread out over a period of time, and that's it's the negative amortization happens when the payment made by the borrower is less than the interest due on the loan. Let's say your interest due on the loan's $150. And the payment you make is only $125. That's a negative amortization, which means it's going to not even cover the interest, and the principal will not go down, and your interest rates will not be covered. It actually increases the balance owed on the loan over a period of time. That's something you want to stay away from. A subprime mortgage, I think you've probably all heard of them. They are mortgages where the interest rate is higher than what a normal mortgage would be. It's usually a high-risk mortgage. Power of sale foreclosure. Usually when you go into foreclosure, the banks or the courts are in charge of it. And a power of sale foreclosure is when the owner takes over and sells the house while in foreclosure and then settles with the creditor. A short sale is when you sell your house for less than what you owe on it. Banks usually have to sign in on this. Equity of right redemption means that once the house is foreclosed on, you still have the ability to buy that house from the creditor before it goes into sale. And statutory right of redemption is similar, but it comes through the court system, which says you have a year after that house has been sold to redeem or to buy it back. So those are some of the legal terms that go along with mortgages. I think this is why mortgages can be so confusing, is because of the terminology. And most of us don't want to ask, okay, what does that mean? So this kind of gives you a basis to start with. Mortgages are contracts in a variety of forms. So it's contractual law that you're looking at. Types of mortgages are a fixed rate, an adjustable rate, we talked about that, interest only. Sometimes you can get a loan that you only pay on the interest only for, let's say, the first 10 years, which gives you a lower interest rate, or a lower payment. Doesn't bring the principal down any, but if the house, and this is the thinking for these, if the house or the property is in a state where it appreciates each year, it does usually end up to be a reasonable arrangement if you're planning on selling it within, say, a 10-year period of time. Subprime, we talked about that, and subprime is just a high-risk mortgage. It has higher interest rates. They're usually more restrictive regulations on a subprime. And then there is the balloon mortgage, where you'll buy it, you've got 5 years, and then you have to refinance. So those are your types of mortgages. We also look at home equity loans, and a home equity loan is equity or collateral you've built up in your house. Let's say the house is valued at $300,000. You have a loan on it for $150,000, and you pay that loan down to $100,000. You, in theory, have $200,000 worth of equity built up in your home, which you could then get a home equity loan on, and usually it's about 80% of that. So you would have a mortgage payment and a home equity loan. And they're riskier for the creditor than a regular mortgage, simply because a home equity loan is on the second tier. The first tier would be the mortgager, the person who you owe the mortgage to. They would get first priority if you were to go into foreclosure. So the home equity loan usually carries a higher interest rate. Then you have a little bit about creditor protection when there's considerable risk. And any home venture that they put out is of considerable risk because it's over a 30-year period of time, or a 15-year period of time. A lot can happen during that time, not only to your ability to pay for the loan, but in the economy, or just in society in general. So it's a high-risk loan. So there are some protections. If you have less than 20% down payment, they usually will ask you to get a mortgage insurance, which will kind of guarantee if you can't pay, the insurance will. The mortgage or the deed and mortgage needs to be recorded in the county, and this kind of perfects the security interest. It kind of records it, sets it up. There are other safeguards, such as the mortgage must be written. It must be a contract, and there are certain things that have to be in the contract. A loan amount would be one. The interest rate, how long of a period. The index rate of when if it's an ARM, that it may go up. Any prepayment clauses that are there. Also, you'll find within the mortgage usually maintenance on the property, simply because the property needs to be protected. That's an investment for the bank. There's got to be a statement of insurance, and that's got to be on file at the bank. There's a list of essential things that must be taken care of, such as taxes, such as insurance. Those are written into the contract. If you break that contract, then the bank has every right to come back and either, pay the taxes for you and add that onto the mortgage, or also to get the insurance and add that onto the mortgage payment. So there are a lot of avenues or additional things that the bank can do to protect its mortgage. And usually if it is a high risk area or a high risk loan, they will ask for this to be paid in escrow into an account that the bank then manages. And a lot of times that's built into the payment. So your true mortgage payment may be $550, but when everything else is added on, you may be paying $700 a month. And that extra money is put into an account to pay the taxes and the insurance as needed. So that kind of wraps up what a mortgage is. You know, it's a contract, and it does follow contract law. And I see we have a question. So again, you can skip along to the question, and I think I'll meet you up at real estate finance law when you're done. All right? Real estate finance law. And this is all new, and particularly after the recession, because the recession literally had a lot to do with subprime mortgages. And that's caused, and it was actually predatory lending practices that led to a lot of this. So there's a lot of new finance laws out there to protect people when they buy a house, because it is such a large investment. The predatory lending was steering and targeting and loan flipping, and actually just not really transparent practices as to what was really going on when somebody got a loan. They really played off of some people's, I don't want to call it ignorance, or I guess a better word would be lack of education on what a mortgage entails and what the terms of that mortgage entailed. So that's all changed. There's a Truth in Lending Act, and that's called a TILA. Disclosures have to be there. You've got a loan principal and interest rate. Sounds like the mortgage, right? But you have to disclose this to people. You can't just give it to them and say, here, sign it. That doesn't work. You've really got to go over the information with the people who are getting the loan. One of the really big things is a standardized form and uniform calculations so that the loans can be compared across each other. So that there can be almost some comparison shopping. It prohibits prepayment penalties so that you can pay early. You must have a fair appraisal. You can't, a lending company can't use their own appraiser for it. It has to be an independent appraiser. And they must use fair advertising. They must tell you the truth. And it has to be very transparent. The borrower has a right to rescind now, and there's many things built into this. So even if the lender isn't being transparent, the person borrowing can go to either a lawyer or to an advocate and ask, is this good? And if it doesn't turn out to be, then they can rescind or refuse the loan. Some of the things that come with the rescission, the mortgage can't be finalized until 7 days after the TILA papers are available. They can rescind within 3 days without that. And if there's no disclosure given, that rescinding right actually is extended for 3 years. If something is disclosed after, say in the second year, something comes up and they said, well, you never told me that, and it comes out it was buried in there, they can refuse that mortgage and get out of the mortgage. And the one thing that is very important that people have to remember at this time is there are written terms, and those terms must be read, because whatever is in the written terms is what is going to be held up in court. So even if they say one thing at the closing or as you're getting the loan, and the written papers say something else, the written papers will take precedent. So it's very important that you read those. There are two other areas that are now covered, and I won't go into those much. There's a high-cost mortgage, and there's a high-priced mortgage loan. Both of these have special disclosures that are required and special requirements that must be met before those loans are approved or before they're even valid. So another question, another hop, skip, and a jump, and I will see you at foreclosures. So foreclosures, this is when a homeowner defaults on the loan. They generally benefit neither the lender nor the borrower. So borrowers and lenders really work hard to avoid a foreclosure. There's something called a forbearance, which I mentioned up here, which can postpone the payment for an amount of time. It can change the payments, make them smaller. It's an agreement, and it's called, it's a workout agreement, and it describes the rights and responsibilities of both parties and redefines how the mortgage may be paid. There's a HUD workaround, which is free interest home loans that somebody who is in financial distress can apply for, and that would keep them out of foreclosure. There's a short sale, which means you would sell your house for less that's owed on it. You have to have the lender's permission, and you have to cover the amount that the sale is short of for the mortgage, but it's better than having a foreclosure on your credit rating. Then there's a sales leaseback, where you would sell the house and then lease it back. Say the bank would buy it, then lease it back to you for X amount that's less than the mortgage payment. There's Home Affordable Modification Program, which is for loans before January 1st, 2009. You have to occupy the house, and what's owed on the house has to be less than some odd number there, $729,750. I don't know where that came from, but and you have to be facing a financial hardship. This would restructure the mortgage for you and help you from not to not have to foreclose and lose your home. You can restructure a mortgage just by just walk in and say, I want to restructure this, I want to refinance, I'm having difficulties, this is why, and most banks will work with you, or mortgage companies. And then there is voluntary conveyance, where you are so close to having it paid off and the bank just says, oh, this is not worth it, we will just call this even up and here's the deed. That doesn't happen very often, but if, let's say you had a year left on the mortgage, it would not be worth the effort that the bank would have to go through. Because in essence, they would have to sell the house for you, take the amount of money you owed on that house, and then give you the rest of the money. That's a no-win for everybody. And then there's a friendly disclosure, which is everybody agrees on it and it's just foreclosed. There's no animosity. The owner usually is the one who sells the house, pays the bills, and we're done. The process is kind of long and drawn out and very costly. The main purpose is to extinguish the borrower's right of redemption. So you must have a standing to sue, which means the bank has to have a right to sue for foreclosure. There are two types of foreclosures: the judicial, which is in the court system, and then the power of sale. We talked about that up there, which is the owners would sell it. There are acceleration clauses that would speed it up. There's a little bit of a procedure. You have to notify the homeowner that they're in default, and then 3 months later you could give them a notice of sale. And that would wrap it up. You've got some judgments that can come down out of the courts. They're very straightforward, but they're also costly and take a lot of time, and they're not fun to go through. So that's why I said it's a win-win if those can be avoided in any shape, way, or form. Is there anything else? I guess there's a question, and then we're going to wrap this one up. Just remember that terminology. The types, okay, the new finance law, and foreclosure. Thank you much.